Look, if a major player fails to deliver, what does that say for the rest of their dealings? And it would create reverberations very quickly. In terms of the price of gold and silver, it would spike in a very parabolic manner because the LBMA is not an exchange. They don't have those types of rules that we see on COMEX. But if you see the COMEX stop allowing delivery because of something like that, I mean, everything goes haywire in a matter of moments.
And this is why Western vaults are being drained, if you like, of any liquidity. Every time gold rises, there's someone in the West who thinks, I ought to take profits at the Chinese or the Russians or whoever say, thank you very much. It's a fair bet that we're looking at something which is, I think, likely to be the early indications of a crisis in the market.
Great. Well, we are dangerously close. And again, I explained that in a lot of detail. It could happen tomorrow. I'm not predicting it will happen tomorrow, but if you said, could it happen tomorrow? The answer is absolutely yes.
In today's episode, 3 financial experts, Andy Schectman, Jim Rickards, and Alasdair Macleod, share their insights and experiences in the world of commodities. They discuss the biggest key performance indicators driving gold and silver prices at the macroeconomic level and share their predictions for precious metal prices. We watched hours of footage to bring you the best clips, so you don't have to. Make sure to like, subscribe, and turn on notifications so you don't miss our daily recaps. Also, check out our pinned comment to take advantage of our massive NordVPN deal. It's the fastest and most reliable VPN on the market, and you'll get 3 extra months for free. This is a perfect fit for stackers browsing investment data who need to maintain their privacy from governments and data thieves. Enjoy the episode.
Look, I mean, it could be much more dramatic than that. These banks, the Bullion banks, are the biggest banks in the world. They're the JP Morgans, they're the Citibanks, they're the Deutsche Banks, the Standard Charter, HSBC. These are the big banks. And if they fail to deliver, creating a massive spike in the price of gold, it would reverberate through all of their dealings. I don't want to say this is the reason, but, so many people are looking at Bank of America. Ted Butler said they're the ones that are short the most, naked short 40 million ounces in gold and 1 billion plus ounces in silver. Now, God rest his soul, he's been dead for a little while. I haven't seen much in the way of update in terms of what they've done with those positions. But look, if a major player fails to deliver, what does that say for the rest of their dealings? And it would create reverberations very quickly. In terms of the price of gold and silver, it would spike in a very parabolic manner. So I don't know. I mean, these are uncharted waters, and this is what happens when you mess around with Mother Nature and you suppress interest rates and you suppress prices that are diametrically opposed with half of the world's GDP, over half of the world's population, countries that are wise to the game and realize that a new system will be one that will be pegged to something like commodities. And this is the only reason they're not bitching, because they're the ones that are benefiting from our stupidity. What it will really do is put the West behind the 8 ball. And I think by that time, maybe, long before that happens, the COMEX would enact force majeure. Now, that it's not going to happen that way on the LBMA, because the LBMA is not an exchange. They don't have those types of rules that we see on COMEX. But if you see the COMEX stop allowing delivery because of something like that, I mean, everything goes haywire in a matter of moments. So I don't know how to answer that question other than to say it's kind of on a razor's edge. But I think the point of metal reacts this way, the markets are reacting this way to just a simple suggestion of a change in policy or any type of geopolitical event. You tell me, how fast would it spiral in the world we live in now? I think it would happen very quickly, and it would be very dramatic.
Now, Jim Rickards discusses how you can protect yourself from the upcoming collapse and stay safe using gold and silver against a potential AI-driven cataclysm that nukes the markets.
We've had some close calls recently, including the Silicon Valley Bank, Credit Suisse, successive bank panics in the spring of 2023. And of course, we all know what happened and that was partly driven by AI, because by then AI was very much in place. So we've had our warnings, and we're very close, and it could happen tomorrow. In terms of what you can do about it, you have to have part of your portfolio outside the digital realm. If the digital realm is automated, affected with AI, subject to all the processes we've been talking about, how do you dodge that bullet? Again, you can use cybernetics or whatever, but that's up to the governments and the regulators. The answer is have some assets that are non-digital: gold, silver, fine art, land, natural resources. There are a list of things where you actually own the thing. And it's, if it was safe storage, and there could be some carry costs and all that, that's all normal. But by the way, this is how Russia has survived U.S. sanctions. Elvira Nabiullina, who's the head of the Central Bank of Russia, in my view, she's the only central banker in the world who actually knows what she's doing. But over 10 years, and I warned the Pentagon about this in 2009, over 10 years, she put 25% of the Russian reserves in gold, physical bullion in safe storage inside Russia. And so when the U.S. froze the Russian assets, the U.S. froze about $300 billion of U.S. Treasury securities lawfully purchased by Russia, held in digital custody in Euroclear in Brussels. Most of them, or 2/3 of them anyway. Those have been frozen, and the U.S. is now in the process of stealing them to finance loans to Ukraine. Again, big topic. We'll leave that for another day. But the reason Russia is not wiped out, the reason the Russian economy is actually outperforming the U.S. economy right now, is partly because she put 25% of the assets in solid gold. And by the way, and as you know, you're an expert, the price of gold has doubled. Well, it's up 70% in the past 2 years, and doubled in a slightly longer time frame. Russia has made as much money on the gold on a mark-to-market basis as they've suffered losses in the treasury securities, because they've made over $50 billion of mark-to-market profits on their gold. But the point is, it's digital, so the U.S. can't touch it, can't freeze it, can't interdict it, et cetera. And those assets are good, and it's money good. So I recommend people have gold in their portfolios. I recommend 10%. If seasoned to taste. If you want more, that's fine. But 10% in a meltdown scenario of the kind I warned about in the book, you'll be fine. In fact, the dollar price of gold will probably soar, because people will be flocking to gold. But for the people who got in early, they'll do fine.
In the continuation of the show, Alasdair Macleod sheds light on the BRICS master plan and what it means for gold and silver prices moving forward. But first, let's take a look at the most relevant headline for the day. Gold price faces strong headwinds ahead of Federal Reserve meeting. After testing resistance at $2,700 at the start of the week, gold is once again on the back foot as stubborn inflation takes its toll on expectations surrounding the Federal Reserve's easing cycle. The precious metal received a much-needed boost earlier this week as investors reacted to news that China's central bank resumed buying gold. After a 6-month break, data from the People's Bank of China showed it purchased 5 tons of gold in November. According to many analysts, the data underscores China's significant role in the gold market and highlights healthy central bank demand heading into 2018-2025. However, the precious metal continues to face near-term volatility as attention now shifts to the Federal Reserve's monetary policy meeting next week. According to the CME FedWatch tool, markets have fully priced in a 25 basis point rate cut following the Fed's final meeting of 2024. There is growing uncertainty regarding the duration of the current easing cycle in the new year. The gold market began selling off this week after the U.S. Labor Department reported that its headline producer price index rose 0.4% in November, following October's unrevised 0.3% reading. Over the last 12 months, headline wholesale inflation increased by 3.0%, well above the consensus of 2.5%, and October's upwardly revised 2.6% reading. The rise in wholesale inflation suggests that the threat to consumer prices remains elevated, which some economists say will discourage the U.S. central bank from raising interest rates. In its outlook earlier this week, analysts at Wells Fargo said they expect only one rate cut next year. Similarly, Bank of America recently forecasted just 2 rate cuts in 2025. Naeem Aslam, Chief Investment Officer at Zay Capital Markets, said gold. Investors should prepare for potential weakness next week as the Federal Reserve pares back rate cut expectations. Another analyst, Lukman Otanuga, is more neutral on gold, noting that the precious metal is caught in a tug of war. He added that while a hawkish Fed is negative for gold, the yellow metal still retains plenty of bullish momentum. Now we'll show you the best clips of the latest interview. But first, hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you keep your data private, especially if you're browsing investing-related material. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
Is continuing to buy. The central banks are continuing to buy. Basically, physical gold is bid only. Not only the central banks, but also sovereign wealth funds in Asia and all the rest of it. And also, quite a lot of the super rich in Asia are accumulating gold. And this is in sharp contrast to the West, where we just sort of shrug our shoulders and say, well, why are they doing it? We are completely clueless about what's going on in the bullion markets. But as far as the East is concerned, they see an increasing need to protect their currencies against an inevitable crisis in the West. And that crisis takes the form of unsustainable government debt, which is leading all G7 countries, with the exception of Germany, into a debt trap. The debt trap comes from two ways. I mean, it's not just the mounting debt. And we had extraordinary deficits for the first 2 months of the US fiscal year. I mean, $625 billion or something. I mean, it's just going up and up and up and up and up. As far as the foreigners are concerned, they see this and they see that there is absolutely no reason why they should buy US dollars and treasury debt at anything like these yields. And the problem is that if they hold off and they want even higher yields, it just makes the whole situation even worse. So what do? You get out of dollars. And to get out of dollars, I mean, you don't want to go into another currency because, the dollar is the king rat of currencies, as it were. You're going to go into gold, which is real money, and they understand it's real money. And that's what we've lost sight of in the West. And this is why Western vaults are being drained, if you like, of any liquidity. Every time gold rises, there's someone in the West who thinks, I ought to take profits. At the Chinese or the Russians or whoever say, thank you very much. So that's basically what's going on. It's the other thing that's extraordinary, which I think I should mention, is the amount of gold and silver that's being stood for delivery on COMEX. I mean, this is a market which, the whole concept of delivery on COMEX wasn't that anybody should actually take delivery, but it was literally to tie an expiring futures contract to the underlying metal price. And but I was totting out the figures. I mean, since Thanksgiving, which is 9 sessions ago, 56.46 tons of gold have been stood for delivery, and 1,240.4 tons of silver. I mean, these are huge amounts. Now, we don't know who's actually taking this. Some of it, I guess, is remaining within the COMEX's vaulting system. But these nonetheless are huge amounts which are being taken out of the establishment's hands, as it were, and going into other hands. And also, if you look at the exchange for physical, I mean, some of the numbers going through there are just absolutely enormous. Now, we don't know which way it goes. I mean, exchange for physical can be inward going or inward coming or outward going. But it's a fair bet that we're looking at something which is, I think, likely to be the early indications of a crisis in the market. I have no evidence that that is the case, other than these extraordinary flows. It just reminds me of the situation we had, when we had COVID, everything shut down, and there was an absolute crisis in the exchange for physical market. I think Hong Kong Shanghai Bank lost something like $200 million on that market alone. So, you can't have a futures market where these enormous amounts are being drained out of it, of physical, and at the same time, I mean, premiums, on futures compared with physical have been rocketing. I was looking at it earlier this morning, silver, it's come back a bit because they've bashed the price hugely. I mean, they really have. And a lot of that has been taking the wind, if you like, out of the futures markets. But this morning, there was a premium in the on the silver futures contract of around about 12.5 to 13% over spot. Why is this? I think that the reason is that hedge funds in particular have seen the problems in the market rising. They know that there's a lack of liquidity and all the rest of it. They never take delivery. They never buy the underlying stuff. They only deal in derivatives. So what they're doing is they're buying, they're buying futures, or they have been buying futures, really to put the squeeze, if you like, on the swaps. And it just smells like a bear squeeze. So we've had a big fall today. I mean, after some very, very big rises. But that a lot of that is just sort of deflating the futures. So there are funny things going on, DK. But it all looks like the markets are running into difficulties, and I don't mean difficulties leading to lower prices. I mean difficulties meaning that the squeeze on the establishment, I think, is really more intense than you would think.
What do you think of today's show? Do you agree with the experts, or do you have a different take? Is all is air right at this time? Will Schectman finally get his moon year? Is AI a real threat for stackers? Post your honest price predictions for gold and silver in the comments section. Where do you see them by the end of this year? And let us know, are you bullish for 2025, or do you think prices will take a breather after a massive 2024? We can't wait to hear your thoughts. If you like this video, check this one right here because you'll love it. I'll see you on the other side.